former colleague, Bill O'Keefe, Director of Derivative Sales at Cboe Global Markets. Bill, thanks for joining me in the studio today. Really appreciate you coming.
It's good to see you again. It's always a pleasure.
Bill, so you and I have a long shared history on the trading floor. We both worked together at MF Global. We both worked together at Spot On Brokerage and later Exchange Financial Access, XFA. And I always remember you being not so interested in the bread and butter of options, the normal calls and puts that everybody trades, but you're always interested in more esoteric, more customized scenarios. And a lot of that was the Flex program that you initiated and took over. And I want to talk about Flex in a little bit, but when it comes to those customized options that you're always interested in, there's a whole new world of ETFs now. And these ETFs emulate various trading strategies using a physically delivered contract, either instead of or in conjunction with the options contract. So I want to start there, use that as a starting point. When it comes to ETFs, for those that don't know, what are they and why might investors care about?
Well, ETF is an exchange traded fund, ETF,
Right.
right? And they came to market back in the early 90s, about 93, I believe. And the Spider was the first one.
Right. That was the big one.
Right, the S&P 500. But they in this one, they hold all the names in it, and it's a fully tradable. It's physically settled, as you said. And then from there, it just grows. I mean, even today, Spider is, as far as average daily volume in options, the SPY contract is the number one contract in average daily volume, about 9 million options contracts traded a day. And as you would guess, the next two, QQQ, which is the NASDAQ, and then the IWM, which is the Russell, those are 1, 2, and 3.
Right.
Again, that just makes sense. Obviously, people could trade the index options, but they're just not readily available to the retail customer.
Yeah. So let me ask you the difference between those three ETFs, for example, the Spiders, the triple Qs in the NASDAQ, and IWM. What's the difference between those contracts, those ETFs versus the bigger index?
But yeah, the bigger index, I mean, that's a cash settle index, right? And
Right.
trading the options, I think the S&P is at over 6,700 now, right?
Hmm.
So a two lot is almost $1.5 million of notional.
Right.
It's very hard for for the retail client to get access to that. Although zero date expiration just kind of changed that cadence, but that's another story. But yeah, obviously the Spider ETF is less notional, point and click. It's simple, and even to access the options are quite simple. The markets are.
Right. So you can get the exposure to the broader market, the broader
Right.
S&P 500 sector, but with less cash up front.
Hmm.
It's physically settled, so you actually have the shares of stock upon exercise or assignment. It's American style, so you can exercise at any time. If you're a seller, you could be assigned at any time, so something to be considered about. Um, Favorable tax treatment.
Yeah, the ETF versus the mutual fund.
Right. Okay. And then, and there was one other thing that just escaped my mind. Oh, dividends. S&P, for example, you're investing in the S&P 500, the SPX index, no dividends there. But with the Spider ETFs, there is the potential for dividends. So it's more attractive for potentially
Oh,
more
return.
attractive,
Yeah.
yeah, for a retail client. Um, the evolution of ETFs, it used to be just a basket of stocks, right? We would grab, the Spiders you had mentioned, the top, 500 stocks. There are a number of different ETFs now that collectively have specific stocks in them, but you can also choose them for a broader sector, kind of similar to an index. But then we've got leveraged ETFs, inverse ETFs, bull, bear, et cetera. As a retail investor, when they see these things, how do they make sense of it? What does that tell them? What does that tell them about the product?
Well, I mean, it might appear to be enticing, but you always buyer beware. You have to know what you're doing. Oddly enough, the one ETF, I'm not going to mention a specific symbols. The largest one is trading 162 million contracts a day, and it's based on a single stock, and it's a 2 times the daily return of that said stock.
Okay. So that means what to an investor?
That means, it seems like, it's a low price. The one I'm referring to is in the low 20s. It seems like it's a good way to enter it. What's behind the scenes is very complicated. There are probably swaps and different things going on in the back. But again, I would say, buyer beware, but it's the most widely traded based on the number of contracts.
Okay.
But before I go on, Spider on the same token is trading 70 million contracts. That's a $670 handle. So on a notional basis, the Spider is by far larger than that.
Right. And I know that, for example, on our website, optionseducation.org, one of our tools is a trending options volume chart. And the top 20 names are pretty much always the same. And the majority of those are the,
The Mag 7s and
right, exactly. The majority of those are, the top ETFs. So more people have embraced the ETF. One of the things that we show is a volume chart, and we talk about, back in the 70s when options were first listed and how, little daily volume or annual volume there was. 2000s is when things kind of picked up, started ramping up. And one of the things we attribute it to is the popularity of the ETF. Sure, they came along in 93 with the spiders, as you had mentioned, but it wasn't really until people started taking a more active role in their investing, managing their 401ks, managing their retirement accounts, personal trading accounts, et cetera, and using ETFs to get that more broad-based exposure to the market that, options volume really started taking off. And then certainly with COVID, that's when everything went parabolic. But certainly in an incredibly popular product that a lot of people are getting into. When it comes to ETFs versus options, tell me about different programs or different products where the ETF actually emulates an options trade without being an option.
Oh, that's a great question because actually the fastest growth in the ETF community now is options based.
Hmm.
Some, they might the reference the spider, for example, that have a call override. That's still not 100% options. But in 2018, one of the ETF issuers came out with this idea to put a structured product in an ETF wrapper, and it's 100% optionality. What it does, using a put spread and a call and a deep in the money call to replicate the exposure delta one,
Right.
you created what's a structured product. You have a buffer, so the first 10% in most examples, you're covered. After that, you go 1 to 1. And then based on that option budget with the cost of that put spread, what call can I sell to cover that? And, with interest rates getting higher and then some of the volatility in the marketplace, last few years, you get pretty generous caps. So you lay down a bet and you can say, okay, well, listen, I could get Marco's up 19%. That's the cap. I'll stop there. That's a good bet. But knowing with the caveat, if the market's down 8%, I lose nothing. So these types of ETFs that are 100% options based have really taken the world on fire. And presently, there's about over 73 billion in these in just 7 short years.
So what you had just described, if I'm understanding it correctly, a put spread collar
Yes.
using an ETF as opposed to using the options. Now, are you just buying that ETF?
Yes, just like any other ETF, it's a symbol and
Yeah.
it's a dollar. It's a $25.
Right. You're just buying
Yeah,
100 shares of that
right.
ETF, and it's giving you that put spread collar exposure without having options in your portfolio.
100%. And you could argue that there's similar mutual funds like that, right? But in a mutual fund, you can only trade it at one time a day at the end of the day. With these ETFs, you can point and click at any time of the day. If you get uncomfortable, you
Yeah.
can sell or buy or do whatever.
Right. And the fact that so many people are the popularity of ETFs, the fact that uh, the volume is so high, so many people are trading it. There's such uh, you know uh, terrific demand for these products. You've got really tight spreads, right? The bid ask spread in the spiders, typically a penny wide,
Right.
right? So incredibly favored. I shouldn't say incredibly, but investors might look at it as having favorable pricing to getting in and out of that trade versus just a regular stock, or even better yet, buying a dozen of those stocks to get that same exposure and the bid and ask widths of all of those different things that they have to take in mind. One-stop shopping.
No,
Almost.
if I go back to the point you made earlier, that as we know, all listed options are American style. What the flex capability or flexible options are customizable. They're done here. Cboe started it back in 1993, ironically.
Mhm.
and you can change some of the cadence. You could have it PM settlement, AM settlement on certain indices. But most importantly, most people that are trading flex options are using a European style settlement. In that example I explained earlier, that if you have a deep in the money call, well, you could exercise it technically in an American style. That would just blow up that structure. So by having this European style exercise, it protects the integrity of that fund for the entire lifespan. Most of these defined outcome ETFs go 12 months, and they usually launch a new monthly strategy. So it's not just that it's the only one you can get into, right?
Mhm.
So there's a monthly cadence of when you can get into these things. So it's pretty cool what you can do with flex options. And what you can also trade a flex option in percent terms. I know this is over a lot of people's heads, but think about it. If somebody's promised you a 10% buffer and a 19% cap, how are you going to get that in the lit market a year from today on the what's it today's the 7th? You're not going to find an expiration on the 7th of next year, right? But you could have you can with a flex option, you could have an expiration any business day of the year.
Right. So the flex option, and it's something that is certainly gaining in popularity. I know, Cboe trades a lot of flex. Some of the other exchanges as well. Flex options, for those that don't know, it's a customizable option. Whereas Bill had said, you can customize your terms, so you can choose American or European exercise. You can choose AM or PM settlement. If there's a strike price, this is something that I always thought was interesting. Let's say you're an institutional firm and you're looking for 10% protection from, the S&P, for example, 10% downside. Rather than saying, all right, and just arbitrary numbers, the S&P is trading 6,000, 10% would be 600. So you're looking for what, like a 5,400
Right.
put. But if the S&P is trading 6102.58, you can actually do 10% to the penny,
Yes.
pretty much, and that's your new strike price.
Right. You would trade it, execute it in percent terms on that day. And
Yeah.
then based on the closing print of the day, then the mathematics is done in the background. You're going to get these fixed strikes that are going to look like, 6713 spot 89,
Right.
for example.
Yeah.
You know,
Right. And then if it is a normal strike price, let's say the terms of the contract match up exactly to what a listed contract would be if that listed contract was in existence. Let's say you're choosing a contract, normal strike price, normal expiration date, et cetera, but 10 years out, and obviously we don't have contracts listed 10 years at this point, but as the years, fall off the calendar, maybe 8 years down the road, now that flex contract matches up with the listed, they consolidate, and now you just have that single contract. The advantage of that to me is that now you've got listed contract exposure in the market. So, now everybody is seeing and can offer those bid ask
yeah, I
markets.
think the point you're making, if you built out a flex trade that doesn't exist yet,
Mhm.
but it will be a standard strike,
Yeah,
yeah, at that point, to your point, once that becomes listed, that flex will morph into the regular.
right. And now you get that regular exposure, dissemination, et cetera.
Flex option, you can technically go out 15 years on flex. Now, I think we have open interest out to 2034
Really?
and SPX stuff. Yeah. And that's mostly bank to bank. I mean, no one at at this table would trade
Right.
something that far. Yeah, right. No,
Well,
typically, you might not
I
be that long.
I gotta tell you, I'm not good for the risk, 15 years down the road.
Right.
I'll sell you all the options you want, but you'll come back.
I'll buy a life insurance policy on myself rather than a 15-year option.
Right, right. So tell me more about Flex. It seems that you've kind of carved your niche at the exchange as being that Flex specialist.
Yeah, what happened when I joined MF Global, back in 2010, the flex options were underutilized, right? I think back then maybe 20,000 contracts ADV was going on.
Hmm.
But I was at a conference. It was at an RMC conference back in 2010. This one gentleman was talking about the insurance annuity book. He was talking about point to point call spreads. This is like a 1 year exposure at SPX. And I'm like, man, they said this is an SPX call spread. Not that complicated. This could be replicated on a flex. So I went up to him after his presentation, had lunch the following day. And then he said, "Oh, that sounds interesting." But they were trading all those over the counter because that was the only option for the most part that the institutionals thought was existed. So I focused on that, and a few years later, then I started onboarding insurance clients within the next 8 months, and just slowly built, and built, and it got to the point where when I was at my last place as a sell side broker, it was overwhelming. I was a one man show, and
Yeah.
now the group that took over has 3.5 people on that desk right now, and it's there's so much to do, and a lot of this stuff is amazing. So one thing I just looked at some stats today. In 2015, just 10 years ago, Felix was trading about 53,000 contracts a day, average daily volume. Today, 1.4 million.
Well,
That's substantial.
yeah,
And then,
significant, right?
yeah, then on September 19th, Friday, I think it was the most Flex that traded. It was 3.6 million contracts traded on one day. I mean, it's here. Then people sometimes in the beginning stages, you remember being on the floor, Flex were, is it by appointment only? No one knew how to do it. Some guy would
Right.
come with a clipboard and you kind of look at the markets around and try to guess, but make it wide to protect yourself. And today it's gotten so robust, and the market makers see this flow coming in.
Mhm.
Market maker told me straight out, Bill, I don't care that it's a listed or whatever. I'm trading my vol curve, right? I'm going to draw my theoretical pricing and my price based on what I believe, whether it's listed, standard, or flex.
Yeah,
And I think that's reflected in the success of these ETFs that have these options in them, because it's not a lot of slippage. It's not get people are getting ripped off.
right.
It's commensurate.
Right. And your normal, not normal, but your typical, Joe investor, they're not going to be trading these flex
They're out of
contracts,
their own.
but they can accomplish the same goal, the same outcome using these ETFs
What,
that you're mentioning that replicate or emulate these flex contracts or even, any of these other more complicated strategies.
yeah, we talk about the buffer protect. The other ones that use an option, there's 100% principal protection as well, where they're I mean you're not going to get as high as a cap, but like an annuity that if I buy this thing, market goes down, I lose nothing. If it goes up, I participate up to this cap. Maybe the cap's 8.5%.
Right.
Not 17 or 19, which you expect in a 10% buffer. But still, there's people that are getting towards retirement and they just, I think this market still has some more legs, but I don't want to lose it. There's a drawdown. So they might look at something.
Yeah. Yeah. Um, Let me ask you this, and this is your opinion only, so I'm not going to hold you to this. And for our listeners, please don't hold us to this as well. But crypto, obviously, it's one of the biggest things, to hit the investing community and ever. How does that tie into ETFs? There's ETF, based cryptos or crypto-based ETFs, I should say, coming online.
Yeah.
What's going to happen with those?
Yeah. Initially, the first ones that came to market were futures based. And then now, I think in January of last year, we got the spot based Bitcoin ETFs. And those are doing really well. In fact, without mentioning any names, the top 5 in ETF options ADV is a crypto ETF. So it's there. It's
Yeah,
there to stay.
people are trading it. It's here to stay.
Right, and there are crypto indices. And
Yeah,
Cboe has their own
right.
a crypto indice, and then now Ethereum is coming into play too.
Hmm.
And that comes at a lesser notional dollar. So I mean, people are playing this. I mean, at first I was like, oh, I don't understand this. How is the Federal Reserve going to even allow something like
Right.
this? But it's here to stay. It's an asset class.
Yeah. Well, I'm still thinking that.
Yeah, I know.
Yeah. Um, well, that's excellent. I really appreciate it. And ladies and gentlemen, that's going to do it for today. That's going to do it for our episode of Wide World of Options. I want to thank Bill O'Keefe, Cboe Global Markets, for joining us. To all of our listeners out there for continued support. If you're interested in our OIC webinar program, I invite you to go to our website, optionseducation.org. Click on the events tab. We've got some terrific content coming for you in the month of November. If you have any options related questions, please reach out to our investor education team at options@theocc.com. Bill, again, thanks for joining me. Really appreciate it.
Thanks for having me, and it's good to see you again.
Yeah, you too. Thank you. And ladies and gentlemen, thanks for tuning in. We'll be talking with you again very soon. Take care, everyone.